Married put. So Deb's question is, when you do a married put, what is the benefit of a put 6 months out versus a leap if I want to continue selling premium and holding the stock? Okay. I've been looking at item number 6, would like to have enough time in case the stock is slow to move up. Okay. So what is the benefit of 6 months out? Well, the benefit is a lower cost basis, Deborah. That's essentially it. As you know, as we've talked about before, the further out in time I go, the lower the cost per day. Meaning the option, of course, that's 5 months out in time or 5 times the amount in time is not 5 times the cost. I get a discount buying further out. The option that's 10 times or 10 months out in time is not double the cost of the 5 month out, and so on and so forth. Let's check Qualcomm real quick. Let's just go to the profit and loss chart. The 6 month out result that comes up is the January 2021 97.5 put at 1287. Okay, well, 780. Let's just get rid of the rounding there. Should just put it at 1290. Okay. So anyway, now my risk is 7.5%, Debbie, and my max risk is 789. Now that's $789. That's the time value for 189 days. Okay, so what did I say? 789. Okay, I'm sorry about that. Divided by 189. Yeah, I'm sorry. So it's roughly about, sorry, I just did that differently. Okay. So 189 days, I'm sorry, a risk of 778. Yeah, 4 cents per day, I'm sorry. All right. So what you're really looking at here, this maximum risk over 189 days is about 4 cents per day, $7.89 or $4 per day. That's not how the time value works, I know, but that's what you're looking at. And that's the 97.5 put. Go out a full year. Remember, the risk on that one was 7.5% for 189 days, for 6 months. We go out to the year. We got 560 days, a year and a half. And the risk is not quite double. It's at 13.9%. The cost is not quite, well, it is more than double because we're going more than double out of the time. We're going 3 times the amount out of time, but it's not necessarily 3 times the cost. Now I've got a max risk of 1568 for 560 some odd days, and that's 2 cents per day. Okay, so the risk is double, not quite double, but for more than double the time. Okay, if you want to put up the capital now, Debbie, you don't mind putting up the extra cost because you're planning on holding this long term and selling against it, there is nothing wrong with going 400, 500 days out in time, what's available to meet your goals for the position. And remember, it's not like this put goes to zero. It's still going to retain a lot of its time value as the stock fluctuates up and down and as we go through different cycles. So you're not going to see this go to zero anytime soon. And it's going to retain a lot of that extra 1,500 time premium because we're only 5 points in the money. There's nothing wrong with doing it. If you're going to plan on staying in the stock long term, continue to sell against it, maybe a couple times around earnings using that income method number 6 and the radioactive trading techniques to leave the upside open. What is a little bit more difficult, Debbie, and it might not affect you because your plan is longer term. Let me do it this way. Let me go back to here. I'm going to open up, we're on Qualcomm. Now, we never do this from the beginning anyway, but here's my 6 month out, January 97.5 put with that risk of 7.5%. Let's say I go out to August, 42 days away, and I get $3 right now, okay, for that 97.5 call. Now we start off with a risk of 7.5%, Debbie, for 6 months. Selling this call right away, although it's 42 days out, seems a little bit far, but it's a good premium. You lower the risk down to 4.7% with a max return of 3.7%. Okay, because we only had to cover that smaller risk of $7.89, and we took in almost $3.10 against it. We didn't cut our risk in half. Okay, we didn't cut our risk in half yet, but we did lower it. Same play with the further out. What I'm trying to show you here is that when you start selling the premium against it, you're not going to have as favorable looking as a profit and loss chart because of that extreme extra cost. Now, it still might see about a 3% return. You still lowered your risk by about 3.5%. That's pretty good. But it's a much steeper, shallower slope, in this case, on the position. Okay? Because why? Well, you had a lower cost on the other position. That's the obvious. So as you first start to sell premium against the married put that's 500 days out, 560 days out, expect a shallower initial profit and loss chart. And again, I said that might not matter to you because your trading plan is to stay in it longer term and to continue to sell different calls against it, Debbie, as well. All right, so those are the pros and cons. Cons of a farther out one is just a higher upside cost, but it does give you a lower cost per day. That's a benefit. Longer time before you start seeing time decay based on the time decay curve. Okay, that's great. Start off with a much higher risk, but it's a lower cost per day, a lower risk per day than the shorter term options as well. I'll use basically an 8 to 7 month out put when I feel like I'm in a more volatile stock that I feel is a good short-term mover, that in the next 2 to 3 months has the potential to really show a good promising movement, a good promising return, sort of the things that Sam mentioned. Maybe not as volatile because the price is very high. But for something I want to hold longer term, and I'm trading as a married put, as you're talking about here, not necessarily Qualcomm, but maybe the Kraft position I'm in or others, I may look to go further out in time from the beginning, not only to collect more dividends in case the position doesn't go exactly as I want, but hey, the longer term, more cost up front, but I'm not going to expect to see as rapid as a time value decay in the next few months. It's going to stay on my side with the time decay, I should say, and you have a lower cost per day, higher cost up front, but averages out, lower cost per day, lower risk per day. And if that's your game plan to keep it long term, absolutely nothing wrong with going out for this 2-year period. In regards to this married put structure, and what we're talking about here with the income method number 6, I blurred it out, and what we're going to talk about here a little bit for Edison as well, is the information that's discussed in the blueprint, the radioactive trading full course that describes the proper setup of the married put that Debbie and I were just discussing, with the 12 different income methods that we can use to lower the risk and potentially bulletproof the trade where we have no risk. Now, one of those income methods that's used is one we don't really talk about in the webinars that much, but it's income method number 9, and it's a way to manipulate the put option if the stock falls against you. Let's go back to the custom spread tool very quickly. Speaking of Kraft, let's say, oh, sorry, January. We'll go to standard January, but I would have bought this before. And let's go to the 37.50. Okay, and it's at 6.50 right now. So I'm going to keep that same price. I'm going to add stock though at $135 per share. All right, 1. Okay. Oh, and so now I do have to do a certain level here. I bought it at 37.50, so it's probably around 440. Now 480. Okay. Let's see if these numbers work out for us, Edison, shall we? Perfect. All right. So let's say a month or so ago, I bought Kraft Heinz at $35 per share. And at the same time, I bought the in-the-money 37.5 around 480. This gives me a maximum risk of 5.8% for a put option that a month ago would have been roughly 210 days out of time. Okay. Now, the stock's fallen. But as the stock's fallen, what's happened? My put's gained in value. I can manipulate the put option to sort of restructure the trade and average down the position. That's income method number 9. Now, it's hard to tell, especially in these types of markets, but the only time I will typically use income method number 9 is when, oh, well, we might have in this case, is when I felt that the stock has hit a low and I'm still bullish long-term on the position. In other words, if I'm sitting here, I don't want to do this income method 9 every time the stock falls to a new level and then do it again when it falls to here and then do it again when it fell to here. I don't want to overdo it. I want to look for the bottom in a time frame, and that's when I consider rolling down the put to reposition myself to see it go back up in time. As a general rule, there's no real general rule, Edison. Your real question is how often should I do it, or when should I stop doing it? How far should you chase the stock down with income method number 9, assuming we are always bullish and looking to hold long term? Okay, my answer to that is once or twice, maybe twice. Okay, I wouldn't do income method number 9 more than twice on a position, and I may go double my initial at risk. So if I did income method number 9 right now and took this up to 11%, 11.6%, Edison, I might be okay with that. If I did it again, it went up to 15%, I'd be very hesitant unless I was extremely bullish on the position. Okay, I will not go beyond 3 times what my original risk was with using income method number 9. I'll either get out of the position and look to make it back somewhere else, or wait for the stock to recover and then evaluate rather than take on the extra risk in case I'm wrong on the position. So that's just our general rule of thumb there. I think that's talked about in the blueprint. You probably don't want to do it more than twice, and you don't want the risk to go more than triple of what you initially started with on the position, because now you're trading against yourself trying to catch a falling knife. Right? It might be better in that case just to wait as well. Okay. So that's my thoughts there on that one. I know that's a quick one, but that's the thought, a general thought there for blueprint owners on the income method number 9, when to stop using it. Sort of what Ernie says as well. But to be honest with you, Edison, Ernie and I have gotten ourselves caught into a trap before. We've exceeded our income method number 9 rules and got stuck holding something longer term that we didn't want to be in with a risk that was too high for what we usually started with. One of mine came back. That's that ON semiconductor. It's starting to come back to a reasonable position where I'm going to use a stock repair on it, to be honest with you. It's back up to around $20 per share. It's been as low as 8, and I did use income method number 9 a couple times on it. But yeah, I'm going to do a stock repair on it because I'm holding an in-the-money put, and I didn't roll it down again because that risk would have been too high for me, Edison. I just let it waffle for a while, and it's had opportunities. It came up to 20, went back down to almost 17, then it came up to 20, almost 21, then it went back down to 18. So it's holding its own right now. It has been. Let's see, it closed down today, but again, it opened. It was really pushing up yesterday. There was a lot of high option volume on it as well, but I did not use income method number 9 on it again because I'm sitting at a 10% risk, and I didn't want to take a 17% risk by rolling down again, which is almost close. The maximum risk is close to where I am right now. It's just a little bit left to go on the put, so I've got to roll it and adjust it and manage that position as well. But I didn't want to do it because I'd be losing 17% now instead of just over 10. 10.2% I think it is.